Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 173, recorded here on July 6th, 2025. This podcast is for entertainment only and is not investing advice. Please do your own homework. We are at block height 904320, Moscow time 918. Fees are 1, 1, and 3. We'll begin with the market update outlook, get into the weekly top Bitcoin news. Check out this week's featured post on the Bitcoin Fortress Substack. Take a look at what's coming and wrap it up. So, with that, let's get into the news. Wall Street closed out a holiday shortened week on a positive note, notching back to back record closes ahead of the July 4th Independence Day weekend. Happy 4th, by the way. Belated. Sentiment was driven by trade deals and a surprisingly strong June jobs report. On Monday, the benchmark S&P 500 index topped 6,200 points for the first time ever, ending a tumultuous and turbulent first half on a high with a plus 5.5% advance. U.S. President Donald Trump announced a trade deal with Vietnam on Wednesday, driving the S&P to another high. The president has said he will not extend the current pause on reciprocal tariffs, which is set to expire on July 9th, and will start sending letters to trading partners specifying the tariff rates they will have to pay. On Thursday, the June non-farm payrolls reading came in significantly higher than anticipated, which helped the benchmark gauge scale another peak. Another notable development during the week was the passage of Trump's sweeping One Big Beautiful Bill Act in both the House and Senate. The president signed it into law on Friday evening, marking the biggest legislative win of his second term. For the week, the S&P 500 climbed 1.7%, the tech-heavy Nasdaq Composite added 1.6%, and the blue chip Dow surged 2.3%. Looking ahead, Wall Street's focus next week will squarely be on trade developments as the 90-day pause on reciprocal tariffs against U.S. trading partners is set to expire on Wednesday. U.S. President Donald Trump has said he will not extend the pause and will start sending letters to countries specifying the tariff rates they will have to pay. With substantially higher tariffs possibly being implemented amid a lack of further announcements of trade deals, investor sentiment will certainly be tested, and the benchmark S&P 500's record levels could come under pressure. Next week's economic calendar is fairly light, with the main event being the publication of the minutes of the Federal Reserve's May Monetary Policy Committee meeting. Though the second quarter earnings season will start in earnest in mid-July, next week we'll see results from the biggest U.S. carrier, Delta Airlines. All right, moving on to the Bitcoin news. This is Hodler's Digest from June 29th through July 5th. And these are the top stories of the week. Ripple CEO Brad Garlinghouse confirmed on X on Wednesday that the company is applying for a license with the U.S. Office of the Comptroller of the Currency following an earlier report by the Wall Street Journal. True to our long-standing compliance roots, Ripple is applying for a national bank charter from the OCC, he wrote. Garlinghouse said if the license is approved, it would be new and unique benchmark for trust in the stablecoin market, as the firm would be under federal and state oversight, with the New York Department of Financial Services already regulating its Ripple USD stablecoin. So the shitcoins are coming to the banking system. Shocker. Standard Chartered. Global Bank Standard Chartered is bullish on Bitcoin for the rest of the year, citing increasing corporate treasury buying and strong exchange traded fund inflows. Standard Chartered expects Bitcoin to print new highs of 135,000 by the end of the third quarter and then break 200,000 by the end of the year. The bank's digital asset research head, Jeff Kendrick, said in a Wednesday report shared with Cointelegraph. Thanks to increased investor flows, we believe Bitcoin has moved beyond the previous dynamic whereby prices fell 18 months after a halving cycle, Kendrick said, adding that the common halving trend would have led to price declines in September or October of 2025. FTX's bankruptcy estate has raised concerns over payouts to creditors in countries with ambiguous or restrictive cryptocurrency regulations. On Wednesday, the FTX estate filed a motion with the U.S. Bankruptcy Court for the District of Delaware, seeking authorization for the FTX Recovery Trust to freeze distributions to creditors in potentially restricted foreign jurisdictions. The jurisdictions, 49 countries in total, have unclear or restrictive crypto laws potentially posing risks due to complex cross-border legal implications. Distributions made by or on behalf of the FTX Recovery Trust into jurisdictions in violation of these legal restrictions may trigger fines and penalties, including personal liability for directors and officers and/or criminal penalties up to and including imprisonment, the filing reads. Boy, it's not easy to extract your coins from the centralized exchange, it looks like. So maybe don't put them on there in the first place. A GitHub repository posing as a legitimate Solana trading bot has been exposed for reportedly hiding crypto stealing malware. According to a Friday report by blockchain security firm Slowmist, the now deleted Solana pump fund bot repository, hosted by account ZLDP2002, mimicked a real open source tool to harvest user credentials. Slowmist reportedly launched the investigation after a user found that their funds had been stolen on Thursday. The malicious GitHub repository in question featured a relatively high number of stars and forks. Slomis said all code commits across all its directories were made about 3 weeks ago with apparent irregularities and a lack of consistent pattern that, according to Slowmist, would indicate a legitimate project. Authorities in the United Arab Emirates have reportedly taken Ildar Ilham, the founder of the decentralized finance protocol White Rock Finance, into custody as part of allegations over a $30 million scam through Z Casino. According to a Thursday X post from crypto sleuth Zach XBT, UAE authorities arrested Ilham in connection with an investigation into wide-scale fraud surrounding Z Casino. Zach XBT's report suggested that White Rock was connected to Z Casino's $30 million fundraising. The alleged investor scam followed Z Casino's launch in April 2024, with the platform promising an airdrop of its native token to select users. However, reports indicate that more than a year later, the funds still have not been returned. Oh, the shitcoining, it'll never end. Let's see. Prediction of the week. Doge double bottom pattern hits at price rebound to 25 cents. We don't care about that. The self-claimed victim of a crypto romance scam who recently sued Citibank for failing to catch red flags has just filed a second lawsuit targeting two other banks. Michael Vidal sued East West Bank and Cathay Bank in a California federal court on Tuesday, accusing the banks of turning a blind eye to their statutory duties and obligations. He claimed he sent 18 transfers totaling nearly $7 million to the alleged scammer's account at East West Bank and made 13 transfers totaling over $9.7 million to an account at Cathay Bank. Wow. Roman Storm, one of the co-founders and developers behind the cryptocurrency mixing service Tornado Cash, appeared in a video interview as his U.S. criminal trial is expected to begin in less than 2 weeks. In an interview released Wednesday by Crypto in America, Storm said his legal team intended to address at trial the allegations that he had personally profited from illicit funds through his role at Tornado Cash. However, he declined to say whether he would testify in his own defense over the charges of money laundering, conspiracy to operate an unlicensed money transmitter, and conspiracy to violate U.S. sanctions. This is the decision that we will make, said Storm, on taking the stand in court. I don't have a 100% answer right now. I may or may not. A U.S. government watchdog has recommended reforms to the Internal Revenue Service criminal investigation division's handling of digital assets, citing repeated failures to follow established protocols. In a Tuesday report, the U.S. Treasury Inspector General for Tax Administration said its evaluation of the IRS Criminal Investigation Division revealed shortcomings around the seizure and safeguarding of digital assets. According to the government watchdog, the IRS failed to follow all guidelines between December 2023 and January 2025 for seizure memorandums around confiscated crypto, detailing the addresses, dates, and amounts. And that pretty much wraps up the Hodler's Digest. Moving along, we have from Cryptopotato, a crypto market update. This was updated on July 4th. Bitcoin had a relatively strong week, which helped it end the second quarter with almost 30% gains and trading around $109,000 by July 4th, pretty close to its all-time highs. The price briefly dipped to around 105,000 midweek following the Senate's approval of Donald Trump's massive budget legislation, but it was quick to rebound. Analysts remain split on the short-term outlook. Standard Chartered maintains a positive view with a $200,000 year-end target, while BitMEX co-founder Arthur Hayes warns of a potential dip to 90K before another rally. The major political development during this week was the passage of Trump's $5 trillion legislation, One Big Beautiful Bill, which makes the 2017 individual tax cuts permanent, lifts the debt ceiling, and rolls back programs such as Medicaid expansion and green energy initiatives. After a narrow vote in the Senate on July 1st, the House approved the bill on July 3rd, following a lengthy Democratic nail biter. Trump is expected to sign the bill on July 4th. The crypto market reacted with a temporary weakness. However, many see the bill's inflationary impact as well as the ballooning U.S. debt as a long-term bullish sign for Bitcoin. Similar fiscal stimulus packages in the past, recall the 2020 COVID relief efforts, led to sharp crypto market rallies. Hence, some analysts believe that this could be a comparable setup. Meanwhile, Tesla CEO Elon Musk criticized the bill's cuts to clean energy, of course, and its impact on federal debt. He even went so far to suggest that he might create a third political party in response. Trump, of course, fired back, suggesting Musk could even face deportation, which escalated tensions between both of them. Other notable developments include the removal of a crypto tax relief amendment, which disappointed miners and stakers. However, the discussions around a U.S. strategic Bitcoin reserve continue to gain momentum. While Bitcoin is currently holding strong, regulatory uncertainty, macro shifts, and political risks remain some of the key variables for the coming weeks. And that pretty much wraps that up. Moving on to Decrypt. This article was posted on July 4th. Mysterious Bitcoin whale moves $8 billion in largest daily transfer of old Bitcoin in history. A whale who had held on to a Bitcoin fortune for 14 years on Friday started moving the enormous stash of 80,000 Bitcoin worth $8.6 billion at today's prices. The coin started moving in batches of 10,000 Bitcoin, or about 1 billion in Bitcoin, early morning New York time on Friday, data from Arkham Intelligence shows. By 11 a.m. Eastern time, the 8.6 billion in crypto had been shifted to new addresses. Eagle-eyed blockchain observers were quick to point out on X that the movements came from an entity that had received the coins back in 2011 as Coinbase transactions, the first transaction in a block created by miners. When miners create new blocks on the blockchain, they are rewarded with newly minted digital coins. CryptoQuant's head of research, Julio Moreno, told Decrypt it is the largest daily movement of coins aged 10 years or more in history. He added that the previous record for a whale that held onto crypto for this long was a transaction of 3,700 Bitcoin, which pales in comparison. Crypto analyst for CryptoQuant J.A. Martin wrote on X, in 8 years of analyzing Bitcoin, I've never seen anything like this, noting that the entity linked to the Bitcoin addresses which made transactions on Friday has over the years held about 200,000 Bitcoin at one point. Connor Grogan, the director of America's biggest crypto exchange, Coinbase, posted on X that the entity linked to the addresses had a fortune of $21.5 billion, making them one of the top five largest holders of Bitcoin in crypto history. Grogan added that if he had to guess, the Bitcoin wallet likely belongs to an OG miner, meaning someone who was very early to mining Bitcoin on the network. In the world of crypto, a whale is someone who holds a large amount of digital coins and tokens. A Bitcoin whale is usually defined as an entity that holds 1,000 Bitcoin, worth $108 million at today's prices or more. Experts previously told Decrypt that although difficult to tell, whales are not always individual investors, but also companies that got involved in crypto mining early. Though given that the stash of coins moving today were acquired years before the industrial Bitcoin mining age, it's anyone's guess as to whether the holdings belong to a single person or a group. Bitcoin was recently trading for 107,895 per coin, according to CoinGecko, after dropping by nearly 2% over a 24-hour period. The leading cryptocurrency is about 4% down from the record high of 111,814 it set in May. When whales start moving their coins after years of hodling, markets tend to move as investors expect imminent selling and therefore downward price action. A little bit of FUD from Yahoo Finance here. Of course, mainstream media, gotta love it. Let's see what it says. So this is from Benzinga and Yahoo Finance. Articles entitled Bitcoin's 5% Problem: Why Most People Still Don't Own Crypto and What That Means for Its Future. And this was posted or updated today, I guess. A simple question posted on Reddit recently sparked one of the most revealing debates about Bitcoin's future. If only 5% of the population owns Bitcoin, what is the use case? Okay. The post, which garnered hundreds of responses, exposed a fundamental tension that's been brewing in the crypto space for years. The original poster laid out the problem starkly. So, if 19 million Bitcoin are presently minted and only 4% of the population are holders, what good is a currency that only 5% of the population owns? It's a fair question that cuts to the heart of Bitcoin's identity crisis, and the answer reveals why Bitcoin might be succeeding precisely because it's failing as a traditional currency. The debate immediately split into two camps, each with fundamentally different vision of what Bitcoin should be. The electronic cash purists point to Satoshi Nakamoto's original white paper titled Bitcoin, a peer-to-peer electronic cash system. As one commenter put it, Bitcoin is explicitly designed to function as peer-to-peer electronic cash. That's literally the title. The digital gold advocates argue that Bitcoin has evolved beyond its original purpose. Bitcoin is not a currency, wrote one user. It is not designed to be used as a payment vehicle. It is designed to be a safe harbor for your money while your government ruins your fiat. This isn't just an academic debate. It reveals a profound shift in how Bitcoin is being positioned and used in the real world. The most compelling counterargument to the 5% problem comes from an unexpected source: precious metals. What percentage of the population owns gold? Multiple commenters asked. The comparison is illuminating. Gold isn't widely used for daily transactions, yet it maintains value as a store of wealth. Similarly, Bitcoin supporters argue that widespread ownership isn't necessary for utility. I don't own gold so that I can take it to Walmart to buy a TV, one user explained. I own gold because its supply cannot be inflated like fiat currency, therefore its value will increase. But critics push back on this analogy. Gold has industrial uses, cultural significance, and thousands of years of history. Bitcoin has math. Perhaps the most telling response to the adoption question was the collective refrain, "We're early." This phrase, repeated throughout the thread, represents more than just optimism. It's a fundamental belief that Bitcoin adoption follows a different trajectory than traditional currencies or payment systems. Adoption isn't linear, It's exponential, one commenter declared. We're still early, and early always looks confusing until it's obvious. The early narrative draws parallels to the internet's adoption curve, credit card acceptance, or even gold's historical role. Supporters argue that Bitcoin's current 5% ownership rate is actually impressive for a 15-year-old technology challenging millennia-old monetary systems. The most damning criticism in the thread came from users who see Bitcoin as pure speculation. Bitcoin, like all cryptocurrencies, is best understood as a collectible asset, wrote one skeptic. Its value is not tied to any underlying cash flows. What gives it value is belief and shared conviction that it's scarce, desirable, and someone else in the future will likely pay more for it. This perspective frames Bitcoin not as a currency or even a store of value, but as a digital collectible whose worth depends entirely on the greater fool theory, the hope that someone else will pay more for it later. Even some Bitcoin supporters acknowledge this tension. I still have yet to meet or see someone pay with Bitcoin. It's always from an investment perspective, one user admitted. The discussion revealed an uncomfortable truth. Bitcoin's current infrastructure doesn't support widespread adoption as a currency. At roughly 3 transactions per second, the network would allow each person on Earth to make one Bitcoin transaction every 3.5 years. In its current state, well, of course, they're talking about on chain. They're not, they haven't talked about layer twos, but that's okay. In its current state, everyday purchases with Bitcoin is akin to going to a secure bank vault just to withdraw $5 for a coffee, one user noted. And again, layer two solutions like the Lightning Network are supposed to address these scaling issues, but they remain largely theoretical for most users. Well, I don't agree with that. They're actually being used. But anyway, reading on. The Reddit debate reveals 3 key insights for anyone considering Bitcoin. Bitcoin's value proposition is evolving. Whether you see this as a natural evolution or a betrayal of Bitcoin's original vision depends on your perspective, but the market has clearly spoken. Bitcoin's store of value narrative has driven more adoption than its payment utility. The 5% problem might be the point. If Bitcoin succeeds as digital gold, it doesn't need universal adoption. Gold's monetary role historically came from scarcity, not ubiquity. The same logic could apply to Bitcoin. I'm not sure I really understand that, but okay. The speculation versus utility debate isn't settled. Bitcoin's future depends on whether it can develop genuine utility beyond speculation. The next few years will determine whether Bitcoin becomes a lasting store of value or just an expensive lesson in collective delusion. The 5% problem isn't actually a problem, it's a feature. Bitcoin's limited adoption might be exactly what gives it value in a world of infinite money printing, but that doesn't mean Bitcoin is risk-free. As one commenter noted, its value is 95% speculation, so 5% seems about right. For investors, the question isn't whether Bitcoin will achieve universal adoption as a currency. The question is whether 5% of the population believing in Bitcoin's scarcity narrative is enough to sustain and grow its value over time. The Reddit debate suggests that for now, the answer is yes. Whether that remains true as central banks develop digital currencies and traditional financial systems adapt remains to be seen. My own take on this is that we are on an adoption curve, so you can't really say, well, 5% adoption is the market speaking, because the market doesn't really know yet. And I'm talking about individuals mostly. When you see the adoption coming from institutions, ETFs, Bitcoin treasury companies, other companies, um, pension funds, investors, the so-called smart money, um, that's adoption. And what's been really interesting about this cycle has been kind of the lack of retail interest, which is kind of mind-boggling. Um, but I think you've definitely got adoption happening, and store value is certainly all over everyone, especially that's really what the institutions are touting, because obviously, use as a currency is not, it's sort of like competing with the dollar or whatever. So they're trying to make the dollar better with all this stablecoin legislation and stuff in order to sell more treasuries, and keep the dollar as a payment rail going longer. And that's fine. That's going to happen. Can't stop that. But similarly, nothing can stop you from buying a coffee with Bitcoin with your Lightning wallet. Nothing can stop you from buying a car using an on-chain transfer. So um, it's um, it's just not easy, and it's not, you know, uh, at least in the Western world, not very common. But certainly, if you go to countries that have terrible currencies and despotic leaders, lots of people are using lots of things. Bitcoin, probably more of the store value there, and U.S. dollar coin or Tether is more of their day-to-day purchasing and where they put their money initially because their current currency is collapsing. So I don't really see it that way that this article portrays, but that's fine. Everybody's got a different opinion. So next up from Bitcoin.com, this is a Bitcoin price watch. This was just updated recently. On the 1 hour chart, Bitcoin exhibited muted price action with tight consolidation between 107,800 and 108,400. The low volume underscored a lack of directional conviction among traders. Scalping opportunities exist within this range, but risk remains elevated due to limited volatility and a narrow spread. Technical signals recommend caution. The relative strength index at 55 is neutral, as are the stochastic oscillator and commodity channel index, indicating indecision. Despite this, the momentum oscillator suggests a modest bullish tilt, registering a value of 1,220, while the moving average convergence divergence or MACD level sits at 853, signaling buying strength. The 4 hour Bitcoin chart reveals a slightly broader perspective, showcasing a rebound from 105,130, followed by sideways consolidation between 107.5 and 108.5. Declining volume points to weakening market momentum, reinforcing the need for a breakout to confirm direction. Key technical levels remain closely watched. A decisive move above 108.5 could lead to a retest of the 110.5 resistance. Conversely, a breakdown below 107 per Bitcoin may pave the way for a pullback towards 105. Oscillator data remains largely neutral on this time frame, while all short to mid-term exponential and simple moving averages indicate a sustained buy trend. Well, if you're a trader type, I guess that's interesting. Um, but if you're a hodler, you just pretty much buy and hold at any price, dollar cost average. Next up, from Bitcoin Magazine. This was posted July 3rd. Senator Lummis introduces digital asset tax legislation. Today, U.S. Senator Cynthia Lummis has introduced a comprehensive digital asset tax legislation that could significantly boost the use of Bitcoin and other cryptocurrencies by cutting the bureaucratic red tape, modernizing outdated tax rules, and supporting Bitcoin and crypto innovation. In order to maintain our competitive edge, we must change our tax code to embrace our digital economy, not burden digital asset users, said Lummis. The groundbreaking legislation is fully paid for, cuts through the bureaucratic red tape, and establishes common sense rules that reflect how digital technologies function in the real world. We cannot allow our archaic tax policies to stifle American innovation, and my legislation ensures Americans can participate in the digital economy without inadvertent tax violations. The proposal introduces a de minimis exemption that would exclude small digital asset gains or losses from taxation with a limit of $300 per transaction and $5,000 annually, and an inflation adjustment beginning in 2026. The bill ensures Bitcoin and other crypto lending is not taxed as a sale, aligning it with traditional securities lending and improving capital efficiency. It also applies the 30-day wash sale rule to digital assets, closing a loophole and promoting tax fairness across asset classes. The bill allows digital asset dealers and traders to elect mark-to-market tax treatment, aligning Bitcoin and other crypto with existing rules for securities and commodities. This allows a more accurate income recognition based on fair market value, eliminating arbitrary discrimination based on asset type. It also defers taxation on mining and staking until the assets are sold, reducing the burden of being taxed on unrealized income. In addition, the bill removes appraisal requirements for charitable donations of actively traded digital assets, making it easier to contribute to Bitcoin and crypto nonprofits and treating it like publicly traded stock. The legislation is estimated by the Congressional Joint Committee on Taxation to generate approximately $600 million in net revenue during the 2025 to 2034 budget window, stated the press release. I'm sure most of that's from the wash sale rule being lifted. Senator Lummis emphasized or applied, I should say. Senator Lummis emphasized the importance of public input in shaping a fair and forward-looking approach to Bitcoin and the broader digital asset economy. I welcome public comments on this legislation as we seek to get this package to the president's desk, she said. So the de minimis limit's nice, but it's pretty low, to be honest. And the wash sale rule exemption currently is actually kind of nice because if you have losses in your Bitcoin, you can sell on December 31st and use that to offset your gains and then buy back on January 1st. And there's no penalty for that. Um, it really sucks with stocks when you do that. But we'll see. Senators propose legislation all the time, and it, doesn't always, in fact, rarely probably makes it to the law. But we'll have to keep an eye on that. Next up from Bitcoin Magazine, why liquidity matters more than ever for Bitcoin. This is posted on July 4th. Global liquidity has long been one of the cornerstone indicators used to assess macroeconomic conditions, and particularly when forecasting Bitcoin's price trajectory. As liquidity increases, so does the capital available to flow into risk-on assets such as Bitcoin. However, in this evolving market landscape, a more responsive and perhaps even more accurate metric has emerged, one that not only correlates highly with Bitcoin price action, but is also specific to the ecosystem. Let's begin with the global M2 versus Bitcoin chart. There's a chart in the article, link is in the show notes, so I'll have to look at that later. Um, this has been one of the most shared and analyzed charts on Bitcoin Magazine Pro throughout the current bull cycle. And for good reason. The M2 supply encompasses all physical currency and near money assets in an economy. When aggregated globally across major economies, it paints a clear picture of fiscal stimulus and central bank behavior. Historically, major expansions in M2, especially those driven by money printing and fiscal interventions, have coincided with explosive Bitcoin rallies. The 2021 bull run was a textbook example. Trillions in stimulus flooded global economies, and Bitcoin surged from the low thousands to over 60,000. A similar pattern occurred in 2016, 2017, and conversely, periods like 2018, 2019, and 2022 saw M2 contraction aligning with Bitcoin bear markets. However, while the raw M2 chart is compelling, viewing global M2 versus Bitcoin year on year provides a more actionable view. Governments tend to always print money, so the base M2 supply nearly always trends upward, but the rate of acceleration or deceleration tells a different story. When the year over year growth rate of M2 is rising, Bitcoin tends to rally. When it's falling or negative, Bitcoin typically struggles. This trend, despite short-term noise, highlights the deep connection between fiat liquidity expansion and Bitcoin's bullishness. But there's a caveat. M2 data is slow. It takes time to collect, update, and reflect across economies, and the impact of increased liquidity doesn't hit Bitcoin immediately. Initially, a new liquidity flows into safer assets like bonds and gold, then equities, and only later into higher volatility speculative assets like Bitcoin. This lag is crucial for timing strategies. We can add a delay onto this data, but the point remains. To address this latency, we pivot to a more timely and crypto native metric, stablecoin liquidity. Comparing Bitcoin to the supply of major stablecoins reveals an even stronger correlation than with M2. Now, just tracking the raw value of stablecoin supply offers some value, but to truly gain an edge, we examine the rate of change, particularly over a 28-day monthly rolling basis. This change in supply is highly indicative of short-term liquidity trends. When the rate turns positive, it often marks the beginning of new Bitcoin accumulation phases. When it turns sharply negative, it aligns with local tops and retracements. Looking back at the tail end of 2024, as stablecoin growth spiked, Bitcoin surged from prolonged consolidation into new highs. Similarly, the major 30% drawdown earlier this year was preceded by steep negative turn in stablecoin supply growth. These moves were tracked to the day by this metric. Even more recent rebounds in stablecoin supply are starting to show early signs of a potential bounce in Bitcoin price, suggesting renewed inflows into the crypto markets. The value of this data isn't new. Crypto veterans will remember Tether printer accounts on Twitter dating back to 2017, watching every USDT mint as a signal for Bitcoin pumps. The difference now is that we can measure this more precisely in real time and with the added nuance of rate of change analysis. What makes this even more powerful is the intracycle and even intraday tracking capabilities. Unlike the global M2 chart, which updates infrequently, stablecoin liquidity data can be tracked live and used on short time frames. And when tracking for positive shifts in this change, it can provide great accumulation opportunities. While global M2 growth aligns with long-term Bitcoin trends, the stablecoin rate of change metric provides clarity for intracycle positioning. It deserves a spot in every analyst toolkit, using a simple strategy such as looking for crossovers above zero in the 28-day rate of change for accumulation and considering scaling out when extreme spikes occur has worked remarkably well and will likely continue to do so. And finally, also from Bitcoin Magazine's, the last three articles, all from Bitcoin Magazine. This one was posted on July 4th. It's a little bit longer read. Bitcoin treasury companies are bubbles. So we've been talking a lot lately about Bitcoin treasury companies, and they're certainly not going away. And let's see what this piece has to say. Half a year has passed since the publishing of my initial report on the company then named MicroStrategy, now simply Strategy. Other than a name change, the company has since then broadened the arsenal of its financial products, accumulated more Bitcoin, and fueled a wide array of companies copying Michael Saylor's playbook. There seem to be Bitcoin treasury companies everywhere. Due for an update, we will now investigate whether or not the Bitcoin treasury company's operations are in line with the predictions made in the initial report, and yet again attempt to conclude where all this is eventually going. In December last year, the company seemed near invincible, with its Bitcoin yield KPI accumulating at a mind-boggling annual rate of above 60%. Optimism reigned. It was no wonder then that most of the arguments carefully laid out in the report released at that time were either ridiculed, ignored, or met with snarling challenges to sell the shares short. The share price, denominated either in dollar or Bitcoin, is at time of writing flat compared to those days, and so far offers little in terms of vindication. Tragically, few understood or even reached the most important conclusion of my December report, which concerns the source of the Bitcoin yield. We will therefore iterate what's wrong with the company's metric and why this should be a cause of alarm for any serious investor. The Bitcoin yield, the increase in Bitcoin per share reaching old shareholders, comes from the pockets of new shareholders. The new shareholders, many of them buying shares in the hope of getting a high Bitcoin yield themselves, provide the Bitcoin yield either directly by buying strategy common shares created in the company's world record sized ATM at the market offerings, or indirectly by buying the shares borrowed and then sold by delta neutral hedge funds that simultaneously hold the company's convertible bonds. This is the Ponzi part of the company operations, publicly boasting a Bitcoin yield far higher than any conventional yield, while obfuscating the fact that the yield stems not from the sale of company goods or services, but from the new investors themselves. They are the yield, and the harvesting of their hard earned money will continue as long as they willingly provide it. The size of the harvest is in proportion to the size of the confusion, here measured as the premium of common shares over company net assets. This premium is nurtured by complicated but inviting company narratives, promises, and financial products. Because the word Ponzi has been thrown Bitcoiners' way over the decade, they have become accustomed, and rightly so, to simply disregard such critiques altogether. But just because a company within the Bitcoin sector intentionally or inadvertently has constructed a Ponzi scheme, that does not obviously mean that Bitcoin itself is a Ponzi. The two assets are separate. During metallic monetary standards of the past, Ponzi schemes existed, but that does not mean the precious metals themselves ever were or are such schemes. When I make this claim of strategy in its current form, I mean it from the point of definition, not from tiresome hyperbole. Before drawing any further conclusions, it is first time to pick up where we left off in the initial report and map relevant company decisions made over the last 6 months. Strategy announced on December 9th that approximately 21,550 Bitcoin had been acquired for about $2.1 billion. Average price approximately $98,783 per Bitcoin. This purchase was conducted with proceeds from the ATM outlined in the famous 2121 plan initiated earlier the same year. Just a few days later, over 15,000 more Bitcoin were purchased, also through the ATM offering, and a few days after that announcement, about 5,000 more were purchased. The end of 2024 saw the company requesting from its shareholders an amendment to increase the number of authorized shares of Class A common stock from 330 million shares to 10,330,000,000 shares. In other words, a 30x. The number of authorized shares of preferred stock was to be increased from 5 million shares to 1,005,000,000 shares, a 200x. All this, though, not the same as stating the full amount to actually be issued, was done to give the company more liberty in future financial operations as the 2121 plan quickly ran its course. By also focusing on preferred stock, another variant of funding could now be pursued. The full year ended with about 446,000 Bitcoin owned by Strategy and with a company Bitcoin yield of 74.3%. The new year started with an 8K filing stating that Strategy was now ready to seek the new funding through preferred stock. The new instrument, as the name implies, was to be senior to the company's common shares, meaning the owners of the preferred shares had a stronger claim on any future cash flows. Initially, a $2 billion raise was the stated goal. While the new instrument was being prepared, 450,000 Bitcoin had been accumulated by January 12th. At the end of the month, all 2027 convertible bonds were called on to be redeemed for newly issued shares, as the conversion price was now below the market price of the shares. Any Strategy convertible bond far in the money becomes unappealing to the largest buyers of such instruments, the gamma trading delta neutral hedge funds who prefer early conversion, followed by new convertible bond issuance over holding the old bonds until maturity. On January 25th, 2025, the company finally filed its prospectus for Strike Perpetual Preferred Stock, STRK, and about a week later, 7.3 million Strike shares were issued with 8% cumulative dividends on the liquidation preference of $100 per share. In practice, this meant a $2 per share quarterly dividend in perpetuity or until the shares are converted to Strategy shares in case the price of the latter reaches $1,000. Conversion was defined at the ratio of 10 to 1, meaning 10 Strike shares must be converted for every new Strategy share. In other words, the instrument is akin to a dividend paying perpetual call option on Strategy common shares. If deemed necessary, Strategy can pay the dividends in the form of its own common shares. On February 10th, about 7,600 Bitcoin were purchased with the proceeds from the Strike issuance as well as from conventional ATM offering of common shares. On February 21st, Strategy issued $2 billion worth of convertible bonds maturing March 1st, 2030, with a conversion price of about $433 per share, representing a conversion premium of about 35%. About 20,000 Bitcoin could quickly be purchased with the proceeds. Shortly thereafter, a new prospectus was published enabling the company to issue up to $21 billion worth of Strike perpetual preferred stock, meaning the already ambitious 21-21 plan of last year now seemed to morph into something even more massive. As soon as the company had publicly announced its ambitious expansion of its funding plan, yet another instrument was announced, Strife, STRF, a perpetual preferred stock similar to Strike, was to go live with 5 million shares. It was to offer 10% annual dividends in cash paid quarterly instead of 8% in cash or common shares. Strife, unlike Strike, had no equity conversion feature, but was senior to both common shares and Strike. Any dividend delay was to be compensated by higher future dividends, with a maximum of 18% total annual dividend rate. At time of issuance, the initial plan of issuing 5 million shares seemed to have been increased to 8.5 million shares, raising over $700 million. With ATM activity for the common shares as well as for Strike, Strategy could finally announce in March that the company held over 500,000 Bitcoin. April saw mostly regular common share ATM activities until that type of funding was all but depleted. Strike ATM activity continued as well, but due to what was likely low liquidity, the dollar amount raised was negligible. With the proceeds, Strategy's total Bitcoin position climbed above 550,000 Bitcoin. On May 1st, Strategy announced the intention of launching another 21 billion common share ATM offering. This announcement came very shortly after the ATM arm of the initial 21-21 plan had been exhausted, and fully vindicated the logic outlined in the previous report as well as on X. As any premium to net assets creates an arbitrage for the company, management is bound to continue to print new shares overvalued relative to underlying Bitcoin assets in order to capture it. Issuance started almost immediately, and more Bitcoin could be accumulated. As the fixed income arm of the initial 21-21 plan already had been extended with the new preferred stock in mind, investors now faced a massive 42-42 plan, meaning a maximum of $42 billion in common share issuance and $42 billion in fixed income security issuance. May also saw the SEC filing of a new $2.1 billion ATM offering for the Strife perpetual preferred stock instrument. At the end of the month, all three ATM offerings were printing shares for the acquisition of new Bitcoin. In the beginning of June, yet another instrument was announced, Stride, STRD, a perpetual preferred stock asset similar to Strike and Strife, was soon to launch. It was to offer 10% optional non-cumulative dividends in cash, had no equity conversion feature, and was junior to every other instrument except the common shares. A little less than 12 million shares worth about $1 billion were initially issued, paving the way for about 10,000 more Bitcoin for the company coffers. With the Strike, Stride, and Strife products launched and Strategy's 21-21 plan in full swing, the full picture of what has been going on in the last 6 months should be clearer. I pointed out in the initial report that the main rationale behind the convertible bonds was not, despite the claims of the company, to offer Bitcoin exposure to a section of the market in need and want of such. The buyers of the bonds were almost all of them delta neutral hedge funds, and being simultaneously short Strategy shares, they never had any actual Bitcoin exposure. It was all a ruse. The true reason that Strategy offered these securities to lenders was that it gave retail investors an impression of financial innovation targeting a multi-trillion-dollar industry, as well as facilitating further Bitcoin accumulation without equity dilution. And as the investors bid on the common shares, so did the price discrepancy to net assets, and the opportunity of risk-free Bitcoin yield grow in proportion. The greater the economic confusion, coupled with Michael Saylor's way of words and vivid analogies, the larger the company's arbitrage opportunity. By issuing three different perpetual preferred stock securities over the last 6 months, in addition to the various convertible bonds already in place, these complicated financial products could now create an appearance of financial innovation, just thus spurring further bidding on the common shares. At the time of writing, the common shares trade near double that of net assets, which is a great feat by company management given the large size and activity of the common share ATM offerings. It means Strategy can continue to buy about 2 Bitcoin for the price of one in a risk-free fashion. In 2024, the company could enjoy tailwinds originating from the popular reflexivity flywheel theory, where it was argued that the more Bitcoin the company purchased, the more its shares would increase in value, resulting in the opportunity to buy even more Bitcoin. In 2025, this self-referential stupidity morphed slightly to a torque narrative, manifesting itself as official company depictions of fixed income cogwheels rotating the core that is the common shares with Bitcoin yield produced from the machinery as a result. Exactly from where or how the yield was created, few investors seem to be asking themselves, and instead the made-up dynamic was mindlessly celebrated. Preferred shares are financial assets and not subject to the laws of physics. Being an engineer, it is not surprising that Saylor should come up with all these fallacious analogies so that Bitcoin yield would appear to stem from what can only be viewed as financial alchemy. But since there are no actual company revenues to speak of, no actual banking, the company borrows but does not lend, the Bitcoin yield must in the end stem from the earlier outlined Ponzi element of the company's business model. Retail investors are dazzled by carefully curated narratives, causing them to bid up the price of common shares enough for the Bitcoin yield to opportunity to materialize. Whatever Bitcoin yield originating from the various debt instruments cannot yet be considered settled, as debt must eventually be paid off. Only the Bitcoin yield stemming from common share ATM offerings is immediate and final, a true profit. Oblivious or not to the fact that narratives can't influence reality forever, the massively successful Bitcoin yield concept of Strategy has spread like a wildfire among management teams of smaller companies all over the world. CEOs have seen how Strategy insiders, by continuously dumping shares on the retail investors currently chasing the shares, have become immensely rich, and so have started copying the playbook. The constant Strategy insider selling can be verified by looking at the numerous Form 144 filings. Many of these companies have successfully pulled this off, already enriching management and old shareholders at the expense of new ones. But it must all end at one point, and many of these companies, grasping in desperation at the bold new strategy of becoming Bitcoin treasury companies due to the conventional main business struggling or even failing, will be the first that are compelled to sell their Bitcoin assets to pay creditors when things take a turn for the worse. Michael Saylor himself once admitted that he was desperate before stumbling over Bitcoin. Metaplanet was once known as Red Planet Japan and struggled mightily to be profitable in Japan's budget hotel sector. Before Melius SA desperately adopted a Bitcoin acquisition strategy, it had undergone a 100 to 1 reverse split. Vanity Coffee SA drifted ever closer to bankruptcy, managing 5 cafes and a bakery in Spain's Alicante region, but its pivot to a Bitcoin strategy now seems to perform miracles for its share price. The notorious meme stock company Trump Media and Technology, with no revenue to speak of, is now pursuing billions of dollars in funding for the purpose of creating a Bitcoin treasury company in order to rescue a share price trading at all-time lows. Bluebird Mining Ventures Limited, also in desperation, I would imagine, at least if the share price is any indicator, just recently decided to sell any gold it managed to mine in order to fund Bitcoin purchases for its treasury. The shares are at a time of writing up almost 500% in a month. H100 Group, a small and until recently struggling Swedish biotech company, has at the time of writing returned to its investors about 1,500% in a month on news that Adam Back, CEO of Blockstream, is funding the company through some sort of convertible bonds for the pursuit of a Bitcoin treasury strategy. The list could go on, but I think the point is made. It is not Microsoft, Apple, or Nvidia that are becoming Bitcoin treasury companies, but failing companies with nothing to lose. Jesse Myers, a strategy supporter and a direct influence on Michael Saylor's Bitcoin valuation modeling, admitted that with MicroStrategy, Metaplanet, and GameStop, they are all zombie companies. They all had a reason to take a serious look in the mirror and say, we can't keep doing the strategy the path we've been on. We have to radically reinvent our approach to delivering shareholder value. All these desperate companies have looked at Michael Saylor and strategy and believe they have found a clear path to riches. By copying the financial alchemy themselves, they are now all involved in a greater transfer of wealth as the Bitcoin treasury company bubble runs its course. Though part of the impressive company mosaic, Strike, Strife, and Stride are all senior to equity. The same is true for the convertible bonds. Not all of them are currently in the money. Future free cash flow will always have to reach holders of these instruments before whatever is left can go to owners of the common shares. In good times, this is obviously not a problem due to the rather low debt ratio of the company. In bad times, the value of all company assets decline considerably while debt obligations remain like tall, looming threats to any new creditor. Due to a phenomenon sometimes referred to as debt overhang, any new creditor will be hesitant to lend for the purpose of paying off other debt obligations. What started as an enchanting collection of narratives and exaggerations morphs into something turning on its creator. This is all exacerbated by the fact that a prolonged Bitcoin bear market will cause further sell pressure on the asset by the many Bitcoin treasury companies than in distress. The more popular strategy's playbook becomes, in other words, the deeper the future Bitcoin crash, likely wiping out much of the equity of most companies having pursued such a strategy to the bitter end. In summary, Michael Thaler likes Bitcoin. He, like all of us, prefers more Bitcoin to less Bitcoin. It is then extremely naive to think that he will let company management pass on what is, by definition, an arbitrage. When common shares trade at a premium to net assets, the company can create risk-free profits for its old shareholders by transferring wealth from the buyers of the newly issued shares. This will continue in the form of ever larger common share ATM offerings, alongside new, obfuscating innovative products, despite protests and mutterings about equity dilution. Evidence of this claim is my prediction made in March, coming true in the form of a new $21 billion ATM offering barely 1.5 months later. If strategy does not act on this arbitrage, all the copycats will capture it instead as they attempt to increase their Bitcoin treasury in an equally risk-free manner. In the frantic scramble to create and expand all these arbitrage opportunities, companies will take on debt in various forms and danger abounds. During the next Bitcoin bear market, the strategy share price will reach and then break below net assets per share, inflicting large Bitcoin denominated losses on anyone buying at today's premium. The best action a strategy investor can take today is doing exactly what the company and its insiders are all doing: sell the shares. Bitcoin is no longer the main strategy of this company, nor of any of the now multiplying Bitcoin treasury companies. You are. Wow. Fascinating article. And makes a lot of good points, I have to say. All right. Um, Wanted to highlight this week's featured post on Bitcoin Fortress Substack. The article is entitled Teaching Kids About Money in a Bitcoin World. Link in the show notes to that. Looking ahead at Bitcoin Fortress coming up in the next several editions, we have Freedom, Liberty, and Bitcoin, followed by Bitcoin and Family Governance Structures, followed by California wants your dormant Bitcoin unless you hold your own keys, and then crypto qualified mortgages, and then the global Bitcoin boom of 2025, and finally Tartaria, Lost Empire or Misunderstood History. I like to jump down rabbit holes every once in a while. Did want to again mention my new book. It is link is in the show notes. It's on Amazon. Working on the audio book currently. And with that, I will thank you for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can also follow my Substack. It's at bitcoinfortress.substack.com, and you can follow me on Nostr. My NPub is in the show notes. And with that, I will talk to y'all next week. Bye bye.